So why don't we go ahead and get started? Welcome, everybody. I'm John Haig. I am the co-director of the Mossavar Rahmani Center for Business and Government. And we are very happy that all of you can join, even if it is virtually. We have an extremely interesting topic, and I will brag about some of the affiliates of the center. We have an all-star cast of people to talk about this issue. They bring a wealth of both experience and intellectual research, grounded research in this topic. And the topic is sovereign debt for emerging markets, past crisis and future challenges. We have with us Carmen Reinhart, Reza Baqir, and George Chouliarakis. Let me start just with Reza to give you a little perspective. Right now, he's a senior fellow here at the center. But he was governor of Pakistan Central Bank from May of 2019 to May of 2020. He led Pakistan's financial response to the COVID-19 pandemic. Before that, he spent 19 years at the International Monetary Fund and 2 years at the World Bank. While he was at the IMF, he handled debt. He was in the debt policy division, overseeing the IMF's work on sovereign debt, sustainability and restructuring. He was the deputy chief of the emerging markets division at one point, overseeing IMF's loans in emerging markets and policies towards managing capital flows. So a wealth of experience to deal with this issue. And then George is, I can't remember whether he's just finishing up or at the tail end of his senior fellowship with the center, but he was chairman of the Council of Economic Advisors of Greece from February of 2015 to July of 2019. And I think probably all of you you remember the kind of Greek financial crisis, and George was incredibly competent in helping deal with this for Greece. He was the alternate minister of finance of Greece, and he was responsible for fiscal policy, the government budget, medium-term fiscal strategy, and public debt. He served as the head of the technical negotiations for Greece that led to what they call the third economic adjustment program, that really actually was critical in making sure that Greece didn't have to do a disorderly exit from the European Monetary Union. He served again as the interim finance minister in the run-up to the elections of September 2015. So he also has a tremendous amount of experience in this area. And then last, but certainly not least, we have Carmen Reinhart, who is the Minos Zombanakis Professor of International Financial Systems here at the Harvard Kennedy School, but also in the kind of aspect of just practical experience from 2020 to 2022. She was the Senior Vice President and Chief Economist at the World Bank Group. She does have private sector experience. She was chief economist at the investment bank Bear Stearns in the 1980s. She was the policy advisor and deputy director at the IMF and a member of the advisory panel of the Federal Reserve Bank of New York and the Congressional Budget Office panel of economic advisors. Again, extremely valuable and important experience, as well as academic rigor in addressing these issues. Hopefully, I'll do a little bit of a plug for Carmen. If you haven't read it, I think one of your most important books you could read is the book that she wrote with Ken Rogoff, This Time is Different, 8 Centuries of Financial Folly. And I think she usually says this, but I think just as a reminder, This Time is Different is being a little bit ironic in the title. But I would encourage you to strongly to read it. So today's topic, as I said, is the sovereign debt for emerging markets, past crisis and future challenges. I don't need to do too much. I'll let them frame the problem. But my kind of very much as a layman in this area is that there have been a lot of negative fiscal shocks since 2019, and they have a particular effect on developing countries. That many of those countries have been shut off from capital markets. Many find themselves engulfed in debt crisis. I think a few of them are actually in default. I think Lebanon, Zambia, a few others are in default. Several others are in urgent need of debt relief to avoid economic collapse. And my background is more in the private sector, but I've seen comparable kinds of issues in the private sector. And it seems like you've got to get debtor countries to somehow adjust. You've got international financial institutions who have to put up new loans and enforce some of that conditionality. And you have external creditors who have to accept some amount of debt and debt service reduction. And then you also have a number of domestic parties, such as bondholders or labor unions, that are involved in this process. And when you have a smaller pie, if you will, seems to me each party often tries to game the system to push a larger burden of the losses onto others, which makes it a complicated negotiating process. So I'll start with Carmen, and the general, from my view, as I said, as a bit of a layman, is this description of the problem fair, and what's necessary to address the problem, and what are some of the ramifications if we fail to address it, and whatever direction you want to go, Carmen, but that'll kick us off. And I do want to say to everybody, we'll try to give you a little bit of time at the end to ask questions. There is a Q&A function that you can put your question into the Q&A virtually, and then we'll try to bring up those questions for the group to discuss and talk about. Carmen, it's all yours.
Thank you, John. It's a pleasure to be here with Reza and George, and of course, John. John, if you could just shout when I need to stop, just so that I ramble on and go overboard. So I'd like to divide my remarks into three parts. The first part is essentially, how did we get to where we get? As John said, we have been especially among the low-income countries, in the worst situation that we've had in a few decades, and I'll get more specific on just how many decades and how many countries. Second part is beyond how we got there and how it compares to earlier crises. Second part is, what have we done on the policy front to deal with the situation? Is this time different? Are we doing something different, or are we, stuck in the same mold as we were in the earlier crises? Major emerging market and developing country crisis that began in the early 1980s, and for the middle income countries lasted till the early 90s. And for the low income countries, it continued much longer, till the early 2000s or late 1990s. Third part is conjectural. What will happen? What is likely to happen? What is my sort of baseline? So without further ado, let me start on how we got to where we got. The one thing that I would point out as my own view, relative to what John said is indeed people focus on the cataclysmic shocks we have had since the beginning of COVID. We have, we had the most synchronous cross-country output declines in per capita incomes that I'm aware of from the data since the 1900s. It was the share of countries that had output declines, and I'm not just talking emerging, I'm talking everybody, was larger than the First World War, Second World War, than the Depression. So that was a major shock, of course, big output declines associated with COVID, which just heightened any kind of public or private repayment vulnerability. We had, since the COVID crisis, the Russia's invasion of Ukraine, which has meant significantly higher energy and food prices for many countries, and for many, especially again, low-income countries that relied a lot on Ukrainian exports of wheat, and even those that relied less, they felt a major shock in the form of a big spike in relative food prices. And of course, the poorer you are, the bigger the share of food in your budget. So the shock is bigger the further down you go on the income scale. But even before that, I would argue that in 2015, you had a major decline in commodity prices. after what I call the golden era in emerging markets. In sort of a historical profile for emerging markets, the early 1980s was bad. It was really bad. You had the largest increase in international interest rates. Chairman Paul Volcker tightened, interest rate spikes. Countries that had dollar debts faced a surge in debt servicing costs. Some of this is sounding familiar, right? I mean, how we got to where we got. And commodity prices collapsed. So the 1980s was bad. The 1990s was better for the middle income countries because the Brady plan addressed the debt overhang. You had significant write-offs, and countries were able to reaccess and capital markets. For the low-income countries, the highly indebted poorest country initiative, the HIPC, didn't come around till 1996 and didn't get established till 2000. So they had almost 2 decades of collapse. And indeed, where we are today, it's the canary in the coal mine. It is the weakest countries, the poorest countries. Not that debt crises have been limited, right? You have middle income countries, you have Lebanon, you have Argentina, you have Sri Lanka, you have Pakistan, as we will hear, that are larger countries that are facing very different degrees of problems, but a core problem is among the low-income countries. About 64% of the 74 countries that were eligible for the debt service suspension initiative that was introduced in 2020 in response to COVID, about 64% of them are either in debt distress or at high risk of debt distress. So that I think gives you a picture of the frail situation, especially among the low-income countries. And the sad part, without being cynical, the sad part about that is because these countries are not systemic in terms of impacting the global capital markets, their crises can linger and fester for many years without any kind of resolution. Briefly on the resolution, as I mentioned, first we had the debt service suspension initiative, which temporarily during the COVID pandemic, early stages, put a grace period, suspended debt repayment for the eligible 73, 74 countries that classified as low income. But that ended, that came to an end, and it was recognized by the international community, by the G20, by the multilaterals, that many of those countries not only needed a temporary reprieve, i.e. they not only needed a temporary reprieve in debt payments, they needed something bigger. They needed debt restructuring. They needed to deal with a debt overhang. And so comes in the common framework. The common framework for debt treatments was introduced by the G20 in November of 2020. I would point out that to date, we have yet to see one debt restructuring, despite the fact that Chad, Zambia, Ethiopia, all applied fairly early on, and most recently Ghana has joined that list. So the debt treatment seeks to bring into the table the largest creditor. I've written a lot about this, the largest new official creditor, which is China. China is bigger than the entire Paris Club group of creditors combined. And so China carries a big foot weight in how debt restructuring is shaped. Another factor that is fairly novel, especially to low-income countries, is dealing with bondholders. Because in the latter stages of that golden era that I alluded to, where emerging markets were growing rapidly and commodity prices were high, many issued bonds. So restructuring is complicated. And the issue of intercreditor equity, i.e. everybody, getting common treatment, is going to prove a particular challenge given the very tense heterogeneity among creditors. So let me conclude by saying, what does it look like? I'll start out with my fear, which is my baseline. My fear is that, and I say this ad nauseum, my students are so sick of hearing this, and I say this at every time I speak on debt. The constant throughout history, from the early 18th century, where British bondholders were major creditors to then emerging markets. The then emerging markets included Greece in the early 19th century, Spain, Portugal, and Latin America, and the constant, whether it was London bondholders, US, American banks that lent a lot to Mexico and Latin America and other emerging markets in the 1970s and got into trouble in the 1980s, or the Chinese, whether it's official or private, creditors want to be repaid. And taking haircuts is very, it's a very repellent attitude. And we've seen this with the Chinese. I was the World Bank representative during the G20 meetings while the common framework was being discussed. Not that the World Bank actually has to say in these things, this is a G20 show, but I was the observer there. And every time the issue of principal reduction came up, it was booted down. So my baseline scenario is not an optimistic one. I think one of the big takeaways from my work on the history of debt restructuring is that, especially for cases that don't involve systemic implications, the process of debt restructuring has been long drawn out. In the 1980s, what you often saw was serial restructurings. You'd get a restructuring, and then 6 months later you get another. And this can go on, and it's very devastating for countries. So I think the call to arms is to try to hasten that process, but that is easier said than done, because again, nobody wants to be the first creditor to get a haircut and have that haircut used to repay debts to other creditors, which is a big concern in the US and the World Bank right now when it comes to also the repayment of Chinese debt.
All right, terrific. Thank you, Carmen. I'm going to keep us moving. George, why don't you give us a few comments, and then we'll go to Reza.
Sure. Thank you, John. And I hope you can hear me well. So I will use my time to walk you through ways to ease the policy trade-offs that emerging markets at risk of debt distress are now facing, though I'm not entirely sure that I will be able to offer many clear answers. So Carmen just gave a very detailed account of the risks to debt sustainability for emerging market economies. I don't have much to add. I will only quote a recent IMF blog by Kristalina Georgieva, a January 2023 blog, where she clearly illustrates how stark is the problem. So I'm quoting, 15% of low-income countries are already in debt distress, and an additional 45% are at high risk of debt distress. We define here debt distress when a country is facing prohibitively high refinancing rates and requires unrealistically high primary surpluses to safeguard sustainability. And among emerging market economies, 25% are at high risk of debt distress and are already facing default-like borrowing spreads. As John said, some of them have already defaulted. Sri Lanka is a good example, Ghana, Zambia. A while ago, Lebanon defaulted back in 2020, if I remember well, and it's still in default. And the same goes for Ecuador and Suriname and many other countries. Now, the truth is that debt levels in several emerging market economies were already alarmingly elevated before the pandemic. A wonderful World Bank report published a couple of months before the onset of the pandemic shows that since the onset of the financial crisis, 2008, 2010, emerging markets witnessed a substantial increase in both public and private debt, with an increasing share of foreign currency denominated debt, which is also very concerning. And as we all know, during the pandemic, sovereign debt increased further to finance policies to mitigate the pandemic shock. Of course, by no means, in emerging market economies, by no means as much as in advanced economies. And we all know that as long as financial market conditions remain benign, the rapid debt buildup did not pose any apparent risk. But the combination of the terms of trade shock of 2021-22, supply chain shortages, energy crisis, and so on, the geopolitical risks associated with the Russian invasion of Ukraine, and importantly, the new tightening cycle in policy have changed the financial market mindset and have increased substantially debt sustainability risks. And I want to pause here and think a little bit more about the implications of tighter policy, especially tighter policy in the United States, for the policy trade-offs that emerging markets are facing, and consider also the domestic policy options that can now be pursued. And since the onset of this new cycle, this new tightening cycle, emerging markets have experienced both capital outflows or nominal exchange rate depreciations, or both, to a degree that we haven't seen since March, April 2020, since the onset of the pandemic. And the domestic policy options are, of course, very limited. To avert an outright debt crisis, they can pursue orthodox policies. Fiscal consolidation is one of them. Targeting support towards the most vulnerable, but reversing the fiscal stimuli of 2020, 2021 as quickly as they can is, of course, a sine qua non, but will have a very limited and delayed effect on debt sustainability. A second domestic policy option would be foreign exchange intervention, effectively selling foreign currency to stabilize the exchange rate. But again, this policy option, I think, can backfire because many emerging market economies need sizable foreign exchange war chests as a signal to capital markets that can weather foreign exchange market volatility going forward. And therefore, I think the thrust of what can be done lies in the hands of the rest of the world, both advanced market economies and, of course, IFIs. And short-term options for the rest of the world would be to, of course, renew currency swap lines, as they did in March 2020. At that time, they played a key role in stabilizing markets. And maybe it's time to extend new swap lines to a wide set of emerging market economies now. Second, quick, I would call it a quick fix, though I don't think it can be sustained over the medium to long term, would be for each country to intervene in capital markets and buy emerging market bonds. It's a proposal that Adam Posen and Maury Obstfeld put forward back in 2020. I think it can be reconsidered and maybe re-energized. But I think eventually in the medium to long term, a lot more needs to be done. And again, the role of the IMF here, of course, will be key. And traditionally, the IMF helps to partially fill a country's gross financing gap when a country is cut off capital markets. And by so doing, it helps the debtor country to also articulate a credible policy package that can help restore confidence and regain market access. But I think, again, the IMF will have to go a lot beyond the traditional function of facilitating regaining market access. One thing the IMF can reconsider is to replace concessional loans with grants to emerging markets. This is again a proposal put forward some time ago by Ken Rogoff, and if I'm right, more recently by Larry Summers as well. Of course, IMF resources will have to be replenished at some point, and advanced market economists must be willing to do so. And therefore, the key obstacle, if you like, here is a political economy obstacle, whether we can reach a global political equilibrium where advanced market economies will be willing to engage in this kind of transfers. The second thing that the IMF can do is to reiterate its commitment to no longer make loans when overall debt levels are unsustainable. A commitment to debt restructuring before engaging with an IMF program would encourage creditors to offer debt write-downs in order to catalyze bailout funds. And I think this is important. This is something the IMF didn't do in the case of Greece, and Greece paid a high, Greek taxpayers, Greek citizens paid a high price. But of course then, and I'm closing with this, of course then we also have a set of countries that are no longer at risk of debt distress, they are actually in debt distress. And in these countries, debt restructuring is inevitable. The main problem we are facing here, and then we'll mainly repeat here what Carmen alluded to, is that we are no longer living in the world of the 1980s, where creditors were mainly a few Western banks or IFIs, and debt restructuring was not easy, but clearly it was a lot more tractable than it is now. Over the past 20 years, the share of the Paris Club fell from 55, the share of debt issued towards emerging markets of the Paris Club fell from 55 to 18%, whereas the share of private bondholders increased from 10 to 50%, and the share of China, as far as we know, increased from 1 to 15%. And in this new environment, of course, coordinating creditors is a whole new game in town. And of course, it's riddled with severe collective action problems. At this point, there is no existing effective framework to bring everything together and facilitate debt restructuring for emerging markets. And I think it's a key priority to work out such a framework if we don't want to witness a new lost decade for emerging markets and low-income countries. I will pause here, and I'm happy to discuss contagion of debt crisis in emerging markets to the rest of the world later in the context of the Q&A discussion.
Terrific. Thank you, George. Reza.
Thank you, John. And let me just first say, really agree with everything that Carmen and George said. Let me also at the outset thank the Mustafa Rahmani Center for the Senior Fellow Program, which has been a wonderful opportunity to engage with scholars at Harvard working on sovereign debt issues. And let me actually remind the audience that I believe the Mustafa Rahmani Center is accepting applications for senior fellows for the next academic year, and I believe the deadline is 1 March. So if you're interested in doing research in any area that excites you at the intersection of business and government, strongly encourage you to put in an application. So the title that is for today's talk is about sovereign debt for emerging markets, past crises and future challenges. And when one attends a panel with a person like Carmen, one really wonders what one can add, and especially given all her analysis on past crises. So I'm not going to say much on a diagnosis of past crises. I'm going to talk a little bit about the future challenges, how I see the current and future challenges. But I want to begin first by trying to illustrate the magnitude of the problem when we talk about sovereign debt. What are the debt levels? How do they compare to the past? And how do they look for the future? So the first point I want to make is that if you look at the IMF statistics, and if you look at the World Economic Outlook, or their fiscal monitor publication, both of which are put out twice a year, and you look at emerging markets in developing countries, the current debt to GDP ratio is about 65% of GDP for this group of countries. So the question is this high or low? Well, if you go back 5 years, just 5 years, this ratio was 50% of GDP. So that means that in 5 years, 15% of GDP of debt has been added on average to emerging markets in developing countries. And then if you look at the 5-year ahead projections that the IMF provides, that shows, depending upon whether it's the fiscal monitor or the World Economic Outlook, debt is projected to grow to somewhere between 75 and 80% of GDP. So what that means is that over a 10-year period, there is an increase in debt to GDP in emerging markets and developing countries as a whole from somewhere between 25 to 30 percentage points of GDP. This is big for emerging markets, developing countries that don't issue hard currencies, that have often exchange rates to worry about. This is a big increase. And this is an average. So even right now, there are several countries that have debt to GDP levels of close to 100% of GDP. And with the average rising, this, for some of the countries towards the upper end of this distribution, the problem is a lot worse than what the average says. Now, I want to illustrate with some actual countries, and I want to show what is the next, how are the next 5 years looking like. And I just want to share one chart for countries that, for just brevity, limits itself to those countries that currently have a moderate to high level of debt to GDP of 40%, and countries that are not very small countries, because in very small countries, debt to GDP ratios can just become very large because the denominator is very, very small. So I wanted to show what that looks like, and I hope you all can see this chart on your screen. What it is, just look on the vertical axis for a moment. It shows the increase in public debt to GDP that's projected by the IMF over the next 5 years. So simply the increase. So if it's 0, that means debt is going to remain at that level. And I have drawn a horizontal line at -5. And that's simply to show that for the bulk of the countries that are above this horizontal line, debt to GDP is either going to increase or broadly remain unchanged, maybe decrease by 1% of GDP a year. My point is that the bulk of countries being above the horizontal line means that these high debt to GDP ratios are going to stick around for a number of these countries. Second, if you look on the horizontal axis, it is the interest expense. And this is important to illustrate the share of resources that are being devoted to servicing just the interest on debt. And here I've drawn the vertical line at 3% of GDP. And it's to show that a number of countries over the next 5 years are going to have more than 3% of GDP devoted to just interest. And for many developing countries where the tax revenue is in the order of 10 to 15% of GDP, this is a sizable amount of resources that are devoted to just servicing public debt. So I wanted to just illustrate in terms of magnitudes that the nature, that the problem is big, that we're looking at much bigger than, say, even when you looked at 10 years ago. So having illustrated that there are a number of countries now, facing debt levels much higher than 10 years ago, the next question is, so what? And here, very often in the public discourse, these high debt levels are then taken to speculate or to question which country will default on its debt. In Pakistan, for instance, that is the question that everybody is discussing in the media. The point I want to make is, while thinking about what countries might default or get into debt restructuring may and is a very relevant question to look at, I think the more relevant question is broader. And where I think we need to devote research and work is, what is the growth loss due to debt overhang? Even if a country does not say default over the next 1 or 2 years, the literature on debt overhang, which basically refers to a state where debt is high enough or debt sustainability is questionable enough that people don't invest and growth is lower than it would be otherwise. I think the real question is, what is the toll that just the debt overhang is taking on growth, as well as on poverty levels, especially in an era where a number of countries are suffering from high inflation? That, to me, is the question that I really worry about when I look at the next 5 years, in addition to whichever countries actually may tip over and then are in a debt restructuring process. Even countries that don't get into a debt restructuring or a default, there are going to be huge income distributional implications for these countries. Now, I want to illustrate all of this. I want to bring it home. I want to make it concrete and illustrate this with the case of Pakistan. Current debt to GDP in Pakistan is around 75% of GDP. The tax to GDP ratio is around 10% of GDP. It's unfortunately the same as what it was maybe 3 years ago. And interest expense in percent of GDP is nearly 5% of GDP. So what this means is that only 5% of GDP is available for Pakistan to meet all its other expenses. That includes security, that includes public services, and a whole host of other areas. Now, what I want to then maybe talk about is that given this state of debt overhang, there is very little investment taking place in Pakistan. Hardly any industrialist that you speak to is looking at long-term investment in Pakistan. And this is going to take a toll. In the 5th largest country in the world, this is going to adversely impact poverty. And with high inflation, create tensions that a country can ill afford. So I wanted to just try to say that I think we need to shift the debate to the costs to growth and to living standards from debt overhang. My last point that I want to make on the issue of what do we do about the current debt overhang is that the current debt situation has increasingly become an official debt problem. And I worry about that. And I worry about that. First of all, what I mean by that is that for many countries, the bulk of their obligations are actually owed to multilaterals and bilateral official creditors. Let me just illustrate from Pakistan. For Pakistan, with a debt to GDP ratio of around 75% of GDP, less than 10% of GDP is owed to private creditors. The rest is roughly half to official creditors, both multilaterals and bilaterals, and then owed to domestic. The rest is domestic debt, which is largely held by domestic banks, which, as we all know, is a very complicated type of debt to have if you think about the options that you have to bring those levels of debt down. If you look at IMF numbers, including in their recent blog, for DSSI countries, they shared that only 13% of the total debt is owed to private creditors and 87% to official creditors. And amongst the official creditors, every $2, for every $1 owed to bilateral, $2 are owed to multilaterals. Now, the reason I worry about this is for two counts. One is that I think official creditors are harder. It's harder to extract a debt reduction from official creditors than from private creditors, especially with the developments in the technology of restructuring for bonded debt, including CACs, by which I mean collective action clauses and aggregation clauses and collective action clauses. I think the technology of restructuring private bonded debt has improved. But official creditors, it's much harder, as Carmen was saying, to extract debt reduction out of them. So that's the first reason why I worry about this more, that getting meaningful debt reduction is going to be harder. The second reason why I worry about this development of a growing share owed to official creditors is that if you take a typical emerging market that has loaded up the liability side of its balance sheet with senior debt, it's going to be harder to reestablish market access, because any lender in the market on the margin to this country is going to realize that they are going to get paid last after this big overhang of official creditors. So let me stop over there, and I don't mean to end on a very depressing note, but I feel that both in terms of the stock, in terms of the nature of the debt, how it's owed, and also the debt overhang, it is a very serious outlook for developing countries and emerging markets.
First of all, thank you to the three of you. That was terrific, and actually, I found it incredibly useful. We do have a number of questions in the Q&A. It's great to see so many former senior fellows asking questions of some of our current senior fellows and faculty. I'm going to start with condensing a few questions together. There seem to be a number of questions about the role of China, given its significant increase as a creditor in this process where it hasn't been in the past. And in particular, for example, how does that change the dynamic potentially of negotiations, the significance of China relative to the Paris Club? And in particular, how does that play out in the process of transparency, the process of cooperation? And then in addition, does China's own kind of domestic financial situation, which is not the greatest at the moment, affect kind of China's participation and mechanisms to help get debt reduction or adjustment in some form? So with that, I'll open it up. I don't know who the best person to answer it is. All three of you commented about China. And I will open it up. Carmen, I see you've got your mute button off, so I don't know if that means you want to talk or it was just off. But
no, I've done a lot of work with Sebastian Horn and Christoph Trebisch on China's debt. Let me say a couple of things, starting backwards with the last statement. What does it mean? China is having its own real estate problems and vulnerabilities in the domestic sector, not to mention that a lot of its overseas debt to developing countries have gone sour. So what does that mean? It typically means lenders become more risk averse. lend less. So China was a big contributor to growth and the expansion of debt that we've seen in developing countries. That process is reversing. We've seen, net flows. So people are very focused on, and George mentioned this very rightly, rising interest rates. What does it mean? Tightening in the US, tightening in Europe. That means lower capital flows to emerging markets, but that's also happening from the East for different reasons. So that's an issue. I think I do want to make one brief comment on something Reza said that it's, I think, incredibly important. I'll take the opportunity to advertise a recent paper that Juan Fara and other co-authors and myself have done on the social costs of debt crises. You see it we know per capita income correlates with a lot of social indicators, but you see it in anything from poverty to nutritional indicators and so on. So why do we care about why, if a country is shut out of capital markets for a decade? Well, the setback to development, the setback, in every social dimension is vastly underestimated. And one last, I promise. On resolution, George, you mentioned, liquidity support. I'm very skeptical of liquidity support at this conjuncture, okay? Because I think often the path is, let's pretend it's not a solvency crisis, that it's a liquidity crisis. So a short-term liquidity support, whether it comes from a swap line or it comes, from a bridge loan or it comes from the multilaterals, all that does is often delay. And there was a question in the Q&A on this, preemptive debt restructurings. Countries going out there and recognizing early that debt treatment is needed. So sorry, John, I had to.
Nope, that's great. Reza.
Fully agree with everything that Carmen said, especially this last point that Carmen made about liquidity support, and just wanted to state in another way that if the underlying problem is a high level of debt, then further borrowing does not help to solve that problem. And I think unfortunately, many country representatives lose sight of this important point when they struggle to just get marginal liquidity. On China, I wanted to, make one additional comment that I think the international community has not been able to figure out how to bring the new bilateral creditors, and not just China, as countries in the Middle East, India, others, into the tent, so to speak, so that they don't feel that other countries are being generous with their money. Right now, according to the IMF, for DSSI countries, for every $1 that's owed to Paris Club, $4 are owed to non-Paris Club countries for bilateral official debt. So to really make progress, I feel somehow the international community has to figure out how to bring the new creditors into the tent, because as long as they have a feeling that others are being generous with their money, we're not going to be able to design an efficient debt restructuring mechanism. Finally, the hesitancy to give debt reduction is definitely not a phenomena unique to the new creditors. As Carmen very well pointed out, creditors just want to be repaid in full and on time, no matter who the creditor is. And I find that even the history of Paris Club is illustrative in this regard, because take a debt treatment like Poland after the fall of the Iron Curtain, and as a number of Eastern European countries were coming out and changing their economies, Poland came to the Paris Club in 1981 for a debt treatment. Even at that stage, Poland's debt situation was such that it was insolvent. but it did not get a debt reduction. It just got a debt rescheduling. Poland had to come repeatedly 5 times to the Paris Club over the course of a decade for 5 reschedulings. Before a decade after it first came to the Paris Club, it finally got a stock reduction of about 50% of GDP that addressed the solvency problem. And Poland never came back to the Paris Club. So imagine if that debt reduction had been given earlier and that period of debt distress and overhang had ended early.
Few points maybe on my part, John.
Yep,
Yeah,
of course.
I don't have much to add on China. I think both Carmen and Reza covered the question. All I would say is that we are now in an entirely new landscape where the collective action problem is a lot more severe than it was 20, 30 years ago. And where the G20 common framework, being a Paris Club-led process, hasn't gained traction and is not able to address cases where China is heavily involved. On the liquidity support point, I take the point, but we need to be careful. I mean, there are countries where countries which are already in debt distress, and of course liquidity support will not help at all. But there may be countries, and there are at least a few of them, where key issues the maturity structure. For example, we should jump into calling them unsustainable if we can facilitate the process of adjustment by providing credit swap lines. Clearly not the main way to address the bulk of the problem. The bulk of the problem that emerging market economies are facing is a sustainability problem, but we shouldn't dismiss it outright. And finally, a point that maybe some of the audience have already raised, I think the support, financial support to emerging markets should be seen, I think, as a global public good and should be addressed as such. And the reason is that without addressing this issue, it's not just emerging markets and low-income countries that will suffer over the next 5-10 years, but also the rest of the world through traditional spillover effects, through slower growth, through balance sheet effects, maybe even through contagion to higher economies outside the emerging market club. But importantly, through climate change policies, countries in debt distress will not be able to make progress in addressing climate change challenges, and also through immigration. I think all those factors make supporting emerging markets now through grants, both in addressing their sustainability issues, but also addressing growth going forward, a global public good.
So terrific. So I want to again combine a couple questions and build off of something that George, you just brought up, but a few people have raised questions about the viability of the common framework going forward, particularly with the changes of, as you said, whether it's China or India or other kind of countries in a kind of creditor relationship, talking about something, the G20 coming up and a kind of side conversation at the G20 around the common framework and how to make it more effective. There seem to be a lot of questions about, as this world has changed, more private debt, if you will, in the process. How do I'm going to be very laymanish. How do I not get depressed about the possibility of actually finding solutions to these problems through negotiated settlements and agreements? And kind of what's the ramification for the common framework? The other piece of that I want to add came from, I'm outing Ted Truman as one of our senior fellows, but he was raising the question of, are we not paying enough attention? Are we putting too much emphasis on emerging markets? And I'll use my own terminology, but not worrying enough about the transmission mechanisms that may lead this to broader problems on a global basis. Ted can yell at me if I got his question wrong, but basically that's a mouthful. But anybody want to comment? It's open.
Quick on that. Look, I think much of the discussion is more focused on low-income countries rather than middle income and emerging markets at this stage, because that's the core of the problem is already manifest. Now, to Ted's question, if I understood correctly, I think there is enormous concern that if it gets to a large emerging market, then you're talking about potential contagion effects, that we have forgotten, right? I mean, not that the 2008, 2009 global financial crisis had all kinds of contagious effects as well, but from a contagion of the emerging market variety affecting advanced economies, you have to go back to the 1990s, like the Russian default of August, which also coincided with the collapse of long-term capital management, and it really hit. It led to the Fed, before its FOMC schedule, it led to an interim interest rate decline. So I think he's right to point out that there are risks that are there if, Turkey goes, if Brazil goes. It's a different story than if some of the low-income countries are affected for the reasons that Reza also mentioned, in which many middle-income countries have a lot of private sector debt, capital market debt, as opposed to official debt, whereas a lot of the low-income countries have more official debt, and they are less impactful in global capital markets.
Reza.
To add to what Carmen said, I think it is interesting that on the question of how to make the common framework better, senior IMF staff already gave cues in a blog that they wrote, but I think the challenge is that nothing is being done about it. So in a blog, the IMF said that there should be time limits on how long it can take for there to be a creditor committee. In Zambia, it took more than 2 years. It defaulted in November 2020. More than 2 years passed before the first meeting of the creditor committee. So that was the first idea. Second was to open up the common framework to middle-income countries. Middle-income countries are not eligible for it right now. And I think the third point was to be able to provide some kind of interim financing while a country is going through this framework. So my first point is that there were these suggestions put forward, but we don't know, the world doesn't know why we are not seeing something happen on that. So that's my first point. My second point is that I find it quite telling that when we have conversations in various fora about how the common framework should be improved, everybody has you can hear everybody articulating a view except China itself, or except India, or except the Middle Eastern country. And I think it would be progress if somehow in some international fora, whether it's the IMF or some other group, one can simply get the new creditors to put forward their vision for how official creditor coordination needs to be improved. I'm not saying that's the destination, but I'm saying at least we get dialogue where the people who matter are speaking, and we're not hearing them speak right now. So I think if we can think about how to create that space where we can hear the views, it would be, I think, forward movement.
George?
Yeah, I mean, I can't avoid being pessimistic. I don't think we have a solution to what should be done to address the sustainability risks of emerging markets. I think history, we know a lot from history, and history suggests that unless we address the problem up front, we will be facing a much bigger problem 5-10 years down the road. We know this. Nobody can dispute it. I think the key issue we're facing now is how to incentivize advanced market economies, maybe like the rest of the world, to accept the cost of supporting emerging markets, low-income countries, to accept the cost of addressing the sustainability risks of emerging markets. And I think to do so, you need to show that the cost-benefit balance is tilted in favor of the benefits. And I think that's clearly the case. And you also need leadership. I think the default option for many countries is to address those issues on a regional level. Europe, for example, can come up with tools to mitigate the contagion risks. I think it would be the wrong way forward.
So we are at the witching hour. I want to thank our panelists. That was, for me anyhow, I found it terrific. And hopefully all of you online enjoyed it. I would apologize to those of you who asked questions and we simply weren't able to get to all of the questions. There were 28 questions in the Q&A, and we probably touched on 6 or 7 of them. So my apologies for that. But again, just a terrific job by our panelists, and I want to say thank you, and thanks to everybody that listened in. We will post this on YouTube as a YouTube recording. So if others you want to share it with others, feel free. I want to thank Reza for the plug for the Senior Fellows Program. Keep it in mind, all of you. And again, thank you everybody for joining.